Hey, everybody, we're going to talk about some of my favorite opportunities in the stock market. Before we do, please click subscribe to my channel and take a minute to check out a message from our sponsor, The Motley Fool, where you can get the top 10 stocks to buy right now. So the stock market started off 2023 great, but it kind of hasn't done well the past week or two. And there are still a lot of cheap stocks in the market. Some of them are big names, some of them not so much. I brought the outside the box thinker Tyler Crow here with me today to give us a cheap stock that you might not have heard of. I certainly hadn't until he brought it to my attention.
Yeah. So, do you want to talk about steel, specifically suppliers to steel factories? Well, I got the stock for you. It's GrafTech International. GrafTech International is a company that builds graphite anodes for electric arc furnaces, hence the ticker EAF, short for electric arc furnace. This is a very interesting business to me because if I make steel, if anybody's heard of big steel making companies like Nucor, they use this technology called electric arc furnace. And that means you basically melt steel with electricity versus, with a blast furnace, which is like heated through metallurgical coal. So in this electric process, you have graphite anodes that you plunge into the steel to like create a current. Those graphite anodes are a disposable product, and GrafTech International is one of the very few companies in the world that actually builds this. I believe that their manufacturing of graphite anodes is somewhere between 25 and 40% of the global demand outside of China. And so they have a huge, huge market share in this particular industry. It's a business that, obviously it's cyclical because it's part of the steel industry, but it's one that's been profitable. It's one that has, throws off cash and has decent margins. It hasn't gotten a lot of attention because it was spun off by one of the Brookfield businesses. I believe Brookfield Business Partners a few years ago had a lot of debt, and they've been using all that cash and just flowing it into, paying down its debt. And they've over the past couple of years, it's been several hundred million to perhaps upwards of $1 billion now as of its most recent quarter. I'll have to double check that. But despite this, all the improvements that it's made in the business, the free cash flow, I get it, it's cyclical, but I can't stop looking at the fact that this stock trades for 3 times earnings. I know, all the analysts say the next 6 months are going to be really rough. Even management itself is saying that the next 6 months might be one of the tougher of them. But for a business that's trading at 3 times current earnings, that's really, really hard to, turn down when it's that cheap.
Yeah, that's a really interesting one. And I mean, 3 times earnings, that seems, too good to be true, but worth a look.
I feel like it
So
prices it a lot to go wrong.
So mine isn't as outside the box as Tyler. Mine is a very familiar company to most. It's General Motors, GM. I feel like this is the most overlooked play on the EV and autonomous vehicle revolution in the market, period, the end. And I'll tell you why. Not only is GM, I mean, it's been well publicized. They're investing, I think it's $35 billion the total's up to now in building out their EV capabilities. They hope to get to $90 billion of annual EV sales by 2030. That's roughly 9 times what they have now. And their brand loyalty will help them get there. A lot of people don't realize this when you're talking about what's Tesla, Lucid, and the legacy makers, is that there's so much brand loyalty here. Someone who drives a Camaro wouldn't drive a Mustang if it was free. There's just so much brand loyalty. And when you have these electric versions of these popular, very, very loyal following models, they're going to sell. GM has the proprietary battery platform, the Ultium platform. It has a software business it's building out that should just get much better. I mean, think of like the OnStar platform. That should get so much more lucrative as EVs become more of their product. They have their defense business, which they estimate as a $25 billion opportunity just for them, as things like the Hummer become electrified. It's no secret that the Defense Department has historically loved the Hummer and those kind of trucks. The BrightDrop logistics business. There's a lot of new businesses. But then you have the autonomous vehicle side of the business, which they have through Cruise, which in my opinion is worth an investment all just for that. It's arguably the most promising autonomous vehicle company. They have paid autonomous ride shares going on in the San Francisco area right now. They have autonomous deliveries going on in, I believe it's Phoenix. That's going to be a massive industry and could change transportation, not just for GM, just for the industry in general. So I think the autonomous opportunity is huge, and GM itself projects that they can double their revenue by 2030 through all these businesses, and that they can produce net margins from that in excess of 20%. That means that in 2030, their net margin would be roughly what their market cap is today. Now, there's a lot that has to go right to get that, obviously. There's a lot of execution risk. I didn't even mention them all, and I mentioned like 7 or 8 new businesses they're trying to develop. So there's clearly a ton of execution risk there. But the stock trades at 6.5 times forward earnings, with just fears of a collapse in demand for cars, and it just seems like a bargain, and just seems like a really kind of sneaky play on what everyone's trying to get through Tesla and Lucid and all the others.
Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.